There is one big question, and that is the stock market going to continue to rise, or is this just baseless optimism? Let's look at the facts on the table. The stock market has hit an all-time high, with the Dow reaching over 15,000, and gold has taken a huge tumble from nearly $1,900 per ounce in August 2011 to $1,200 an ounce in June, with a 10% rebound in July. Altera Senior Managing Director Ralph A. Campora said recently, "We've got a lot more to go on the upside." He said, up and away." Jeremy Siegel, a finance professor at the Wharton School, argues that the Dow could hit 17,000 or an additional 13%. And Michael Toomey of Western International Securities told me that the stock market is sound, with 65% of the companies beating forecasts, and that the Dow will hit 17,500 by the end of the year. Though the stock market index has more than doubled since March 2009, making this one of the strongest bull markets in history, I think that there's a downside we need to look at. Mark Gongloff of the Huffington Post points out that though the Dow has erased its memories of the crisis, many households aren't so lucky. Neither jobs or wages have regained their pre-crisis highs. And the job market has recovered only 5.5 million of the 8.7 million jobs lost, making this the worst labor job market recovery since World War II. Let's look at earnings and returns. One commonly used valuation metric is the Shiller PE10 ratio, which is based on average inflation-adjusted earnings from the past 10 years. Today, the level is 24.69, which is more than 40% higher than its historic average of 16.5. Back in January 2000, just before the bubble burst, the PE ratio reached 43.8. Here is some historical evidence showing the relationship between the PE ratio and forward returns averaged. You can see when the PE10 ratio was above 25.1, and we're very close to that, the real return over the following 10 years averaged just half of 1%. I think that this is a big concern. So what does this all mean? This is a market timing tool, and it does set expectations. So investors who want to achieve a higher return could be very disappointed. So what do 1929, 2000, and 2007 all have in common? Those were years that we all saw a dramatic spike in margin debt. Investors were highly leveraged to take advantage of a soaring stock market, and we all know what happened then. The spike in margin debt was rapidly followed by a horrifying stock market crash. And guess what? According to blogger Michael Snyder, this past April, margin debt rose to an all-time high of $384 billion. The previous high was $381 billion in July 2007. Margin debt is about 29% higher than it was a year ago. Investors are just buying stocks because they expect the Fed to keep stimulating the economy and are borrowing near record amounts of debt, according to Bank of America Merrill Lynch figures. Today, after-tax corporate profits are more than 10% of GDP, while the historical average is closer to 6%. One big reason is that the corporations pay much less taxes than they used to. In 1951, corporations paid almost half of reported profits in taxes, and in 1965 they had to pay more than 30%. Today, they pay around 20%. Also, with globalization occurring, many American companies are receiving up to 46% of their earnings from abroad. And with the sluggish labor market and the decline of the unions, many corporations have been able to cut their payrolls, thus keeping profits high. Whether we live in a bubble or not, we live in a world that is confusing and changing. USC professor and economist Dr. Larry Harris says that anything that has to change will change. We just don't know when or what that change will be. One day you will wake up and find things are very different. Today there is a huge demand for physical gold around the world. Central banks and citizens alike are demanding physical possession. This is causing an economic transfer of wealth from the west to the east. It is only time before the stock market bursts and gold will soar. This is only a great opportunity to buy physical gold and silver. Let me help you protect your wealth by investing in physical gold and silver.